Good afternoon, everybody, and welcome to the second class in our COVID Cancellation Conference 2. This class is called Jumpstart Your Portfolio Return with Small Companies, and we're going to be discussing our annual best small companies list that Mark Robertson and I put together every year. I am joined by my friend Mark Robertson. He lives about 45 miles almost due south of where I live in Michigan. And between the two of us, we've been on the phone quite a bit trying to get these classes ready for export.
Well,
if you could go to the next, go on, Mark, say hello.
I was just going to say this is going to be a whole lot of fun, and I expected some abuse on my subtitle that I injected onto the cover slide there.
Well, I'm not sure what it means, so I kind of skipped it.
The joy of six? Oh,
yeah.
Man. We need to talk. We need another car ride sometime soon. But,
okay.
This is one of the things we love to do, and it is a needle in a haystack adventure, and it's a whole lot of good, clean fun. Do you want me to do the disclaimer, Ken?
Sure. Go on, Mark.
All right. Many of you, I see a lot of familiar names in the group. Welcome back. Great to see all of you. No investment recommendation is intended. You know the drill. This is all about an educational demonstration. It is for illustration purposes only, and it is all about education. Basically demonstrating the techniques, methods, beliefs, et cetera, of the modern investment club movement as interpreted by Manifest Investing or promulgated by NEIC Better Investing. We may own stocks that we talk about, and we try to disclose that when we do. Please do your own homework and don't run out and buy anything that you see mentioned here until you have done your own homework and made your own decision. If you'd like a event email reminder about our monthly broadcasts like the roundtable or the weekly sessions that we do, but for the roundtable, the reminder would come via Natalie Kavula and Kavula1 at Comcast.net. If you would like copies of these slides, or if you have any follow-up questions, just send it to Mark R at manifestinvesting.com. If you do have a question for Ken, he is actually Kavula1 at Comcast.net. Not on the slide, but it's just a secret handshake. Why don't you go ahead, Ken?
Okay, our agenda for the 3-day COVID cancellation conference. Yesterday we opened with a session called the Stock Pickers. Today we're going to talk about small companies, and then we're going to move to Prove It to Me, talking about the return on value based on the enterprise value of a company. A very, very important number that we don't talk about very often. Tomorrow, Cy Lynch is going to be presenting a class at 2 p.m. Where we're going to talk about ways to confirm and validate your stock selection guide using sources outside of the traditional SSG sources. And we're going to wind up the whole thing with a Let's Talk Stock panel beginning tomorrow at 3 p.m. We'll have some of the best stock pickers in the Better Investing community, and they'll be there to give you their best idea going forward for the next year or so. We'll also examine some of the picks we made last May at the first COVID cancellation conference and see how well they've done. So if you get a chance to join us, please do. You can register through our own Mid-Michigan page on the Better Investing website, or you can send an email to my wife or to myself asking us to send you links, and we'd be more than happy to do that. Mark?
All right, I think we'll just start with our 30-second. It's kind of like in the Mid-Michigan area, and this is a Mid-Michigan program. There are tapestries on walls around Thanksgiving tables with this stuff written on them, up, straight, and parallel, all that kind of stuff. This is the type of core belief system that we have within the modern investment club movement. One, invest regularly, whether that's monthly, weekly, annually, or whatever. Just make sure that you're consistently getting involved. Fortunately, with 401ks and things like that, it can be easy to do. It can also be challenging. Remain invested. That's just a simple keep your money working. Don't overdo it with trying to time the market. There can be special considerations for people with a whole lot of experience and that sort of thing. But in general, and specifically for investment clubs, you want to stay pretty much excuse me, fully invested. Our mission is to discover and own leadership growth companies. We want companies that are excellently managed, that have a robust field of opportunity, and that's what we're out there looking for. Prudently diversify, mix up the types of companies amongst sectors and industries. Don't obsess over it. Go where the opportunities come from, but also make sure, and we're going to talk about this a whole lot because Ken said we have a little bit of an emphasis on this yesterday. I think he stumbled over that little bit part a little bit because we think it's really important to have enough growth, sales growth expectations in your portfolio. So we'll be talking about that.
Mark, I want to jump in and emphasize that these slides will be available. All you have to do is send an email to markr@manifestinvesting.com, and Mark will be glad to send those slides out, and give him a chance to finish the 2 classes today before you start pestering him. But he should have those slides ready to send out this evening or definitely tomorrow morning. That email again is markr@manifestinvesting.com.
All right, so several years ago, I used to make trips up to the mid-Michigan area, up in central Michigan, and I harbored this notion that finding small companies was difficult and that they're all roller coasters, and I met a guy named Ken Kavula that set me straight on this. So I'll let you go ahead and preach for a minute, Ken.
Well, I don't want to preach very much except to say that if you can keep focused on the idea that you should expect from your small companies most of the same things that you expect from your large companies. We've all learned in our chapter that up, straight, and parallel is a fine way to manage 3/4 or more of your portfolio. For some investment clubs, it's 100% of the portfolio. But in order to have a variety of sizes within your portfolio, sometimes you need to go to small companies, and that means you want to take just a little bit more time, but emphasizing this whole idea of up, straight, and parallel, of consistent growth in sales and consistent growth in earnings, maybe not for as long a period of time for your small companies, but definitely for the last 3, 4, 5, 6 years. If you emphasize that, stick with that, then you can hit a number of home runs because you can find a small company in its early stages of growth, and you can ride that company for the next 12, 15, 18, even 20 years, ride it into the place where it stabilizes as a very large company, and you can make a lot of profit in doing so. Again, expect from your small companies some of the same things that you expect from your large companies.
Yeah, in fact, when we sit down and do this effort every year, I somewhat jokingly, and it's actually not jokingly at all, say to Ken, I want to find 15 neogens and 5 other promising companies that might have a shorter track record. And if you're not familiar with the Neogen story, you want to look up the ticker NEOG, do a stock study on it, sit back and enjoy it, marvel at the up, straight, and parallel, because this is a tiny company out of Lansing, Michigan, that has been a contributor to many local portfolios for many years now. So that's all part of the deal. Many of you will also remember going back over 20 years ago when we used to interface with the Forbes magazine, fastest growing, or actually they did call it best small companies, as I recall it, Ken. And for years we would basically take our divining rods, known as stock selection guides, and look over that list. It always came out around Halloween, so we used the kids on the left as our memory meme to trigger us to remember that. And we've been actually doing that as a community effort for many, many years. That changed about 6 years ago when Forbes abandoned that effort, and we kind of took it over. So we want to talk about that. We had a very good year over the last year. We run these from Halloween to Halloween, and last year was quite good to us. All right, I'll kick this off, Ken, and then you can come in and drive the point home. we refer to all of the above investing, and you already heard Ken mention and talk about it. It's I would call it urgently important for most investors to have a blend of stalwarts, these stable blue chip companies that are in your portfolios, and you know the names, the Aflacs, Johnson and Johnsons, Colgate Palmolives, and you know those type of companies. You got to have some of those. But you also want to have a bunch of medium-sized workhorses. And then you also want to have some faster-growing companies to really help bolster the portfolio. And that's what we mean by all of the above investing. The graph that you're looking at actually goes back to the year, I believe, 1994 and 1995. So you're looking at a 25-year chart of the Value Line Arithmetic Average. That's the companies that would be in the Value Line Standard Edition, and basically an index based on the prices of the companies that are in that black book going back, again, 25 years, versus the S&P 500 as represented by the mutual fund VFINX, and that's just simply to make sure that we're accounting for dividends also in there. So again, every company that is in that blue line in the S&P 500, I'm 99% sure that they're all in that Value Line Arithmetic Average too. So what that is basically saying is the small and medium-sized companies make a tremendous difference in the Value Line Arithmetic Average. And it's just a reminder that you want to be invested in small, medium, and large, a blend at all times. And you can see the difference. Now, the kind of highlight from this year, well, I don't know if it's a highlight or not. Back in March, it certainly wasn't a highlight. But just a reminder that the small and medium companies do tend to correct more significantly than the blue chips in the S&P 500. But what I want to draw your attention to is how rapidly they recover. Going back to the 2008, 2009 time frame or what we've seen here in the last 6 or 7 months. So just something to keep in mind. Did you have anything on that, Ken, that you wanted to add to that?
No, I just think it's so important that you understand that the 1% difference in return, when you compound that over 20 or 30 years, ends up creating huge amounts of wealth for any portfolio. Of course, we'd like that spread to be even larger if it's possible, but even a 1% gain on the S&P amounts to significant wealth accumulation over a 20 or 30 year period, and that's all due to the magic of compounding.
Yeah, in fact, Herb Lemkool asked in the green room before we got started if I thought it was too late, if the small companies had taken off and gone too far, too fast, or some way of thinking about that. And there's some of that is true. But what I want you to notice is that for the last 3 or 4 years, this has actually been relatively flat compared to the long-term trend, and certainly not as steep as the S&P 500. So I think they're basically just coming back to kind of a normal position of opportunity. It's certainly not subdued at this point. Here's a look at the profile of the companies that are in the Value Line Standard Edition, and basically distributed on this chart by their growth rates, ranging from 0 on the left over to greater than 25 on the right. And again, we tend to lean on the definition of the company size really being representative or reflected by the growth rate of the company. Younger companies grow faster, and they slow down as they mature. So we're really talking about the companies on the right-hand side of this. In fact, some of you may remember the Red Chip Review that was out there for a while. I'm not even sure if it's still in existence, but they focused on going after those higher growth, smaller capitalization type companies. And again, we've adopted the bunny as our mascot for this effort every year, the Red Rabbit. All right. Let's go ahead and really drive this point home, I think, Ken. We haven't shared this graph or this slide too many times with the audience. They've seen versions of this, but I think this one really makes that point about urgent and things that work and why we do them and why we should do them. What you're looking at here is a list of the 29 mutual funds and exchange traded funds that actually beat the market for the period shown. Most of them are since December 2010. So we're talking about a 10-year track record. There's a couple exceptions up at the top. So a long-term track record. And then this is the answer to the question, what funds beat the market by more than 5 percentage points a year? Now we track about 600 funds at Manifest, so we're looking at, less than 5% of the entire mix. So these are the exceptional. We refer to them as super investor. If you're familiar with the work of the Graham and Doddsville super investors from Buffett and that whole bunch of people who've been beating the market for years. So these are the 29 that actually do that. These are not specifically selected to be small company funds. And as Ken and I were going through the search for ideas to consider for this year, and we're going through this list, we were just kind of taken by, notice that column that I've circled there. That's the sales growth forecast, the weighted average sales growth forecast for the funds that are shown here. And what I want to draw your attention to is that the average sales growth forecast for these funds that have demonstrated success is 14%. It begs the question for me, Ken, that maybe we ought to be shooting for 14 in our model portfolios and round table and all that, where we've been going for 11 or 12. What are your thoughts on that?
Well, I'm just thinking that I've been willing to stick with things that Mr. Nicholson has said, and he proves to be right more often than not. And he has given us the advice that 12% might be a really great sales growth number to stick to if you're aiming to double your money every year. That's that 15% growth number. If the average of these is 14, I think it really makes it clear that in order to achieve that 14% sales growth, there have to be small companies in almost every one of these portfolios. It's very difficult to achieve a sales growth. I'm looking maybe at number 8, the Fidelity Advanced Growth in red there. It's just at 14, slightly under 14. How can you achieve that sales growth without some small companies? And that means that if it has small companies in the mix, then I'd kind of like to know what it's investing in, as well as I'd like to know what almost any of these top performers are investing in. In other words, Mark, I'm teeing up the ball for the next slide, I think.
I don't think this is the next slide, but it's coming in a bit, because we are going to drill right into one of these and demonstrate that, yeah, this is where you can go looking for ideas. Those of you that are out there that are curious about why 3 of them are in red, those are funds that have relatively large commissions, upfront loads, anywhere from 3 to 5%, and we generally think you can avoid them. That doesn't stop us from mining them for ideas, but that's the reason that they're in red. The other thing that I'd like to point out is that a number of the smaller company funds are closed to new investors, and that can be a problem that you run into trying to invest in actual funds to cover this stuff. But we will be taking a look closer inside one of those here in a minute.
I think it might be appropriate also, Mark, to talk about a 3-letter word that appears in a lot of the names of these things here, and that's that word cap. Please keep in mind right from the get-go that small cap does not necessarily mean small company, and mid-cap does not necessarily mean medium-sized company. Capitalization and the amount or the rate at which sales increase aren't directly related to each other. And we've seen, especially in hard times in the market, like we've experienced recently, or like the Great Recession back in 8 and 9, we've seen companies which we instinctively know are large companies by the way their sales are growing, but their capitalization was at the small cap end. Take Ford Motor, for example, whose stock price plunged to under $1 during the Great Recession. That certainly makes it small cap, but at no point did I anticipate thinking to myself that Ford Motor could be classified as a small company with greater than 12% sales growth. It just wasn't going to happen. So keep that cap in mind. We're not talking about capitalization. when we say small companies. We're talking about sales growth rate, always focusing on sales and understanding that everything that happens in a company begin with revenues, begin with sales.
Yeah, in fact, Ken's given away one of our secrets because, one of the things that I think is a problem on Wall Street, one of them is just this emphasis on cap. And he's already given you the answer. We're only aware of one mutual fund, and it's just barely off this list. It might be like 1 percentage point off this list. Brown Small Company. It's the only fund that we know of that actually says small company, and they are small company. Just something to keep in mind. We are always mindful of what they're doing at Brown Capital in their small company fund. All right, Ken, you ready to revel a little bit? Here is the.
I sure am, Mark. Yep.
Here's the track record for years. And like we said, we had followed the Forbes best small companies for many years, including those years shown from 2006 to 2014. And then I'll let Ken share the nightmare of what we found during Halloween 2015.
Well, sometime in September of 2015, Forbes announced that it was no longer going to publish the list, that it was going to change the list from the 200 best small publicly traded companies. It was going to change the list to the 200 best companies. And that essentially it was going to look at privately held companies that you could invest in as an angel investor. You could invest in if you were trying to be a capital allocator, but you couldn't go to a public exchange and buy shares of many of these companies that list became. Well, Mark and I said in September of that year, we can do some of this ourselves, set some of the rules, maybe give ourselves an opportunity to slightly change the rules a little bit, and maybe we can do as well as the list has been doing. Those red bars represent how well the list appreciated versus what the Wilshire 5000. That's a very, very broad index made up of somewhere around 5,000 companies. But that list had done really well for the previous 8 or 10 years, and we wanted to keep it going. Well, if you look now at our history, we have 6 years of history under our belt now, and we've managed to beat the Wilshire 5000 in all 6 of the years, sometimes by a lot, vis-a-vis 2015 and 16, sometimes by not quite so much, but always we've been beating it by an amount that is significant as far as statistics are concerned. We shouldn't be able to do this with a list of 20 or 25 small companies, and yet it is happening. Here's the proof right here.
Yeah, and I mean, we love that number 10% for the long-term performance for the market, so it's kind of cool that we're looking at that number here. And the average annualized return for these best small companies checking in at 5, that 5 percentage point potential advantage is enough to get you out of bed, in my opinion. So, Ken, that's where the joy of 6 comes from. 6 consecutive years.
No, it is all fit together since the opening slide, Mark.
Yeah, we don't need to talk about that.
I was not looking for a pun on a famous book. Okay.
But anyhow, and we're going to talk about this, and then I think the next slide are coming up. We basically modified what Forbes had been doing for decades, and basically sat back and literally put our feet up and said, how would we do this if we did it like George Nicholson and the Modern Investment Club movement? What would we go looking for in small companies? And again, that's where the Neogen comment comes from. Notice that for this 6-year period, the average annualized return is actually almost 10 percentage points better than the total stock market. And that will make a substantial difference in your portfolios. So here's basically where we ended up. Again, Ken, I'll let you take off, but up, straight, and parallel is possible. So go ahead and describe what we decided to do.
Yeah, well, the graphics speak volumes. If you look at those 3 sets of graphics at the top, top line sales or revenue, bottom line earnings per share. And you look 1 dot per year, so we have a reasonable amount of history on all of those graphs. We have certainly they're moving in an upward direction, and certainly those lines are fairly straight and fairly parallel to each other. We don't even have to put the name of the company onto those graphs before we can say to ourselves, this is a company that I'm interested in. And of course, that's where we begin our search for these companies, devising a list from source material anywhere we can source it. And I think Mark has a slide in here later on to show you some of the source material we use. But once we've gone through that list, company by company, looking at just revenues and earnings, looking for up, straight, and parallel, then we apply a few sets of rules. We'd like the growth in sales to be at least 12% or better, although we're not tied to it in such a fashion that we wouldn't consider a company that was growing at 11 if it had other outstanding things going for it. But 12 or better is the general rule of thumb. We'd like revenues to stay less than $1 billion, but again, we're going to give our companies some latitude. In some industries, when you have the majority of the companies with revenues above 15 billion, a company with revenues of 1.5 or 2 billion might very well be considered a small company. We also don't want to look at the micro companies, the micro small or the mini companies. So we ask for revenues to be around 50 million or greater. And again, a little bit of latitude is allowed. Let's keep the stock price above $5. And let's generally exclude asset-based businesses, because in most circumstances, when the market is behaving, these businesses don't meet our criteria because their growth rates aren't big enough. Now, this is an exceptional year when we're going to see 5 asset-based companies make our list. And a lot of that has to do with the fact that we have a lot of asset-based companies. I've been saying that about 15 times. That means companies like banks, insurance companies, some of the fintech industry, financial tech industry. We've had these companies trading at historic low values, and that means they have potential moving into the future that are historically high in a lot of cases. And when that happens, they will make a list like this, and we're going to see some of those on our list. Best, we define best or better as excellent quality companies and a superior return forecast. In other words, when we chose these companies for the list, we thought that an average person doing a reasonable stock selection guide would find these companies interesting to the point where they might be considered a buy. In order to rank them, we used manifest rank, which is a combination of return forecast and quality together. And that became our primary screen to kind of rank these companies. So again, to put this in a few words, gather as many companies as you like, apply a few simple rules, and then rank them by manifest rank, which talks about return and quality, and then distill that final list from a handful, maybe 50 companies that are left when you begin to sit down and ask yourself, what are the particulars about each one of them? Mark?
Okay, good stuff. All right, we won't spend a lot of time on this. These were the companies that we selected a year ago. I don't think it's been, every year we see a spread between high and low. I don't think we've seen them quite this big in many of the years. Etsy obviously stole the show. Biospecific Technologies actually just got bought out or is in the process of being bought out at a fairly hefty higher price than it had been trading at, but a whole bunch of companies trading in the middle there. So again, the rule of 5 does tend to to play out. It just tends to flatten out sometimes. And of course, there's a couple of companies down at the bottom which have underperformed. Cantel has underperformed for 3 straight years. So we were wondering if it would make the list again, and it didn't. It just missed, which probably means we all ought to run out and buy it for our real portfolios. But underscoring here, the average quality rating of these companies is in the good range. So you can have companies that are fairly young, faster growing, that still have decent quality in the way that we measure it, and some pretty good results from top to bottom. One of the other things that I do like to remind people when they get investing into this realm, you see all that red ink at the bottom, and it kind of causes a bit of panic. The thing I like to point out is that Etsy would completely consume all of that red ink if you add up the numbers. So again, that's how you get to a combined portfolio performance of like 20%. It's a jigsaw puzzle with multiple pieces. Don't focus on any one piece of that puzzle too much, and be careful with cherry picking a list like this also. Ken mentioned that we do have a number of sources that we turn to. We do like the Emerging Handbook from Hoover's, and we'll scout that for names that we've never heard of before. I mentioned Brown Capital Small Company Mutual Fund. The ticker symbol is BCSIX. That's one of our favorites. It's 5-star, gold rated, long-term track record with a heritage in the investment club movement going back to the 1970s. It's a fascinating story, and we do love to keep track of what those guys are up to. We screen in the value line, small and mid-cap editions. We use Morningstar. We will look at funds. We're going to talk about that in a minute. For some specific individuals, David and Tom Gardner at the Motley Fools and their gems, that kind of stuff. Chris Jenner used to run the T. Rowe Price Health Sciences Fund. He now runs Rock Springs Capital Management, where he is out there looking for, the biotelemetry type companies, the emerging healthcare companies. And he's got one heck of a track record. Some of the stuff done at the American Association qualifies, and every year we get ideas from our community. Special nod to John Kimmel and Kim Butcher and Marie Frank for some of the stuff that they've brought to us. And again, we do watch the stock selection contests we talked about yesterday for ideas and new names. We love to see a new name that somebody has flagged as potentially interesting in the way that we like to look at companies. Anything you want to add to that, Ken?
No, I think this is a pretty good start. You could spend probably a whole year just focusing on the value line small and mid cap edition. One of the things that we try to do is to go through that entire edition. That's a lot of grunt work because it's hard to screen on some of the things we're looking for. But you go through that entire edition looking for companies that have some record of profit and some record of consistency of sales. And then you ask yourself whether that company is being followed by anybody significant, any significant group, including, is it included in the manifest database? If it's not included in the manifest database, that's one of the places where we'd like to start to get a little bit of a feel for how the company's done in the past and how it's going to do. But just that one source right there can keep you busy for a whole year.
All right, so let's come back and talk about this list and how we use it. I think of this as over the shoulders of super investors. These people know what they're doing. Many of the funds that are listed here do specialize in smaller, faster growing companies. And again, it's very consistent with what we try to do in our community. We are focused on the results we're trying to achieve, the outcome that we want to achieve, and that is market outperformance. So monitoring the things that are interesting to people who have already demonstrated they know what they're doing. These are the kids in the classroom with A+ report cards. That's what we're doing. We are watching the ones with the A+ report cards. Now, that doesn't mean that's the only place you'll discover an idea in a classroom, but it's a fairly reliable source to turn to. Wanted to give you just a quick example of the type of thing that we do for every one of these funds. And Ken and I spent a couple hours a few days ago digging into these in great depth. This is that fund up at the very top. It's Motley Fool, small cap growth. And it's been around for a few years. I happen to know them personally. I know some of the people that are involved. So there's a bit of a bias there, but they're knocking it out of the park for the first few years of operation. And I understand the methodology. It's basically exactly the same methodology that we have. And so drilling into that fund, you can see on the left-hand side, that's the output of the actual holdings in the fund. I believe that is from Y charts. And on the right-hand side of that page, this is the characteristics and attributes in a connection with manifest investing. So for every fund that you see listed, we have that list side by side. This is updated continuously. It changes minute by minute. And anytime a new ticker shows up amongst one of these accomplished stock pickers, we basically put it, challenge it with a gauntlet of stock study in the fashion that we do. Now, Ken's head was spinning a little bit while we were doing this the other day. I think he was kind of impressed. Is that fair to say, Ken?
I was slightly impressed. I was blown away, Mark. I remember how we used to have to do these, and that meant we had to go to Morningstar, and then we had to drill into the portfolio, and then look at the portfolio, and then pick out what was going on. Now we just ask Y charts to drop the 25 highest holdings, largest holdings from these funds onto basically a spreadsheet for us, and the spreadsheet updates itself on a fairly regular basis, and we're getting par values, we're getting proof numbers, we're getting quality numbers, we're getting all kinds of things that we would have had to spend probably 20 minutes doing for a single stock a couple years ago. Now we're doing it for stock after stock after stock, and it's pointing out things that we never saw before, and that's fascinating, and it's explosive as far as I'm concerned. It should lead us to a lot of new ideas that would have just walked right by us in years past.
Yeah, so I would expect our small company effort this year to become a blend of passive, the 20 that we picked, and then a more active. We'll be doing something with that because this is very powerful stuff. All right, let me summarize what we did end up with our list for 2021 before showing you the list. That's what you're all here for. You can see the word average starts every one of these lines. The 20 companies that we chose have a sales growth forecast of approximately 18%, a projected annual return of about 20%, an average quality rating bordering on excellent at 76, a projected return on value in double digits at 16.5, a relative strength index, which means they're not too much momentum or too little momentum. It's kind of like a Goldilocks relative strength index of 50. The average Irish Spring in honor of Hugh McManus position means that they're positioned halfway between their 52-week low and their 52-week analyst consensus estimate high. Their Morningstar price to fair value is 12% discount to the fair value, so that's a good thing. And the average analyst consensus price to fair value is actually a 20% discount to the fair values, with a fairly robust 1-year expectation from the analyst consensus also. And so that's a pretty good set of metrics. We're pretty excited about what we ended up with. Here are the 20 companies from top to bottom. There's a few repeat companies on here, but not too many. We'll basically leave it to the audience to take and do individual studies of these. But MKSI and Biotelemetry, that company I mentioned a few minutes ago, Kim Butcher picked BAAT for the roundtable fairly recently, and Cy Lynch did MKSI. Ken has done Western Alliance for the roundtable in the recent past, and LGIH is also a Kim Butcher pick for the roundtable. I believe, Ken, you might have picked that also.
Yes, I have.
Yep. So there's a number of companies that we have had in some of our forums, but there's also some new names to that list.
Well, I want to say, Mark, that we've allowed a Chinese company to creep onto the list also. That First company on the list, Global Cord Blood, is a Chinese company. Doesn't have anything to do with food products or drugs, but they do operate blood banks where they collect cord blood from newborns. Very interesting company. We're reasonably certain that the numbers are reliable and can be compared to the numbers that we see from non-Chinese companies, from U.S. companies in particular. But we debated it back and forth, and we decided to let that Chinese company move on to the list. We also have allowed one company that does most of its business in China to move on to the list, even though its home office is based in Fremont, California, and that's the last one on the list, ACM Research. They do about 75% of their business in China, but they're based in Fremont, California. They're an older company. They date back to 1998 with their roots in Silicon Valley. And essentially what they do is build or create ways of cleaning chips that are on their way to go to chip manufacturers. Chips need to be cleaned, and these are little tiny pieces of silicon, some of them three-dimensional, and ACM has different ways of dealing with cleaning these chips. So it's an interesting company. I've been reading up on it. I spent about 45 minutes this morning reading material from their website and reading complementary material from different sources. Again, an American managed company that does most of its business in China and East Asia.
Mm-hmm. Ken, there's actually another, and I don't want you to break into hives or cold sweat or anything, but Autohome does principally all of their business in China and that side of the world. That's actually the Chinese version of OnStar or Uconnect. I don't remember what the other one is. So that Autohome is actually a Chinese company also. So there's a lot of Chinese content here. Are you going to be okay?
I'm going to be okay, and I did remember that we had two, but I just couldn't put my finger on what the second one was. So.
All right. These have been red hot in response to Herb's question. Obviously, you probably don't want to run out and buy EBIX, that's for sure, and ACM that Ken was just talking about. This is just in the last few days. My way of looking at this is to say these stocks have had a good year in just a week. Some pretty powerful performance since Halloween. So you want to factor that into any considerations you have. And we do have about 5 or 6 minutes, so we can spend some time talking about a few of these. And I know this just warms your heart, Ken, to see these type of pictures when it comes to these type of companies.
Right, here's that idea again, Mark, about expecting the visual analysis especially to look pretty much the same for some of these small companies as you would expect it to be for the large companies that you invest in. We deliberately don't have names attached to these pictures, and I would challenge any of you to match the graphs to the correct one of the 5 companies above it. It's a fairly difficult thing to do, and when it's all said and done, all 5 of these companies have nice straight lines. Now, I will tell you they always don't have straight lines that go for 9 or 10 years. Maybe for a smaller company you have to understand that 3 or 4 years is enough history, and that might be all you have. They always don't have earnings lines that are as straight as you'd like them to be, especially if the company does a reasonable amount of acquisition. And in its early infancy stages, many small companies are kind of eager to tack on things that complement their business model. So you'll see earnings choppy a lot of times, but generally, if they're moving up at about the same rate as sales are moving up, and if you have good, solid consistency in sales, then you have a good candidate to take a look at as far as small companies are concerned. We spoke a little bit yesterday about how some of our clubs were looking at early stage investing and looking for companies where there was an evidence of a very strong sales growth line, but no evidence of profit or very slim evidence of very recent profit. And they weren't banking on our traditional model, but they were essentially doing the same thing we're doing right now, only they were moving it back even to an earlier stage, hoping to hit a home run on a contest stock and maybe using some of their actual capital to invest a small portion of their portfolio in some of these more speculative kinds of very small stocks. It's okay to do. Mr. Nicholson, way back in the 40s, was telling us non-traditional investing in things that don't fit the model. That's okay. Just don't start doing it until you have a little bit better understanding of how investing works, and make sure that the majority of your portfolio follows the model of up, straight, and parallel, follows the high quality growth company model. And again, keep everything diversified and you have a chance to make some real money in the long run. Anybody figure out which of these companies goes with which graph yet?
Sure they will. Pretty sure Auto Home's one of them. Yeah, it's a great point, Ken. And in fact, one of the leading mutual funds for discovering small companies over the years has been this Virtus KAR Partners. And in fact, the company that runs that fund is on our list this year. Virtus KAR has been at the top of that list. It's number 4 on this list. You can see that it's closed to new investors, and it does have hefty sales charges associated with it. But it's been at the top of our lists for many years. And the actual parent company of that is amongst our top 20 for this year, third one down on this list. And so with that, I think we'll just leave it for the audience to go back and pour over that list. I'm sure that some of these are I'm going to actually bring Emergent Biosolutions tomorrow to the stock panel, so we'll cover that one. But some pretty interesting investment opportunities, pursuing them along these lines. And we're most grateful for the Red Rabbit and how kind it's been to us. Hopefully there's no jinxing associated with talking about it too much. We were kind of worried a year ago when we talked about how wonderful we were doing, and then October hit and almost took away our advantage last year, but we did survive it. So any closing comments, Ken? Because we're running up against, we have another session in about 10 minutes.
Yeah, we're running up against the clock right now, Mark. So I'd like to just thank you for all that you've done for this class and to help us put this conference on. I'd like to thank our audience for being here and being quite attentive. Our next class will begin at 3 o'clock, and Mark and I will be talking about Prove, return on value, enterprise style. Thanks a lot, folks. Goodbye.